Hi, I'm Brenda Wells. I've got, wow, 38 years of experience in this field, so it's a pleasure to be here.
My name is Sue Myers, and I'm an insurance broker. I've been doing this not 38 years, but probably 20, well, not probably 26 years. And I work for Marsh McLennan Agencies, as you can see from one of these sides up here. And most of my clients are real estate owners, real estate developers. So I come at this perspective a lot from the way my clients look at it. And then I'll just call on, how about Reed? Why don't you go next?
Yeah, sure. Good afternoon. My name is Reed Peterson. I'm an attorney in Greenville, North Carolina, and I practice primarily in the areas of corporate law and estate planning and estate administration, and particularly in the intersectionality of those, whether it be on the planning side or the administrative side. So happy to be here today. Also joined by Mr. Alex Sharp, so I'll let him introduce himself.
Hey, thanks, Reed. I really appreciate that. So Alex Sharp, I've been doing this a very long time, which is why I don't have hair, and the hair I have left is gray. So um, most of my work these days is with really two factions. I do a lot of work with uh, publicly traded and privately held companies, mostly advising senior executives and boards around their governance practices, including risk management. And I also work with governments, international standards bodies, and industry organizations for, around policy standards and regulations. Um, you know, most because of the nature of my work, I tend to look at things from a lot of different perspectives, which I think really, being good at one makes you better at the other. So, David, why don't you introduce yourself?
Thank you. My name is David Pooser. I'm a professor of risk management and insurance at East Carolina University. Before joining the faculty here at ECU, I was on the faculty at St. John's University for a little over 10 years. And I've taught corporate risk management for a number of years. I've also published a bit on the area of enterprise risk management. My dissertation was actually on enterprise risk management. And so I would say that modern corporate risk management really follows what a lot of those budding principles of enterprise risk management were 10 and 15 years ago. So I look forward to speaking about that.
Great, thank you all for being here. I would like to introduce this by saying risk management is probably the most underrated and underappreciated corporate function there is. If you're not familiar with it, it's basically anticipating what can go wrong and figuring out a plan to survive it. And some companies are really good at that, some of them not so much. And so what we're talking about today is for entry-level people who don't understand risk management. It is an essential part of a successful business strategy. So we're just going to introduce the basics. I'm going to start with define risk management. Alex, would you like to take that?
Sure. I want to say that I guess I didn't fully appreciate David's background until he introduced himself, but I have to tell him he hit the nail on the head. What we now refer to these days as, risk management or governance, risk and compliance really does have its fundamentals in the field of enterprise risk management. I think because of the way the world has changed, that has, a combination of being lost or not understood. But in very simple terms, from a business lens, risk management is really about handling your downside. So if you look at an organization, an ongoing concern, which is a fancy term for a business, it really has two sides, right? You got the value creation side, which we usually measure in revenue in terms of dollars. And then we have the risk management side that protects the value generation activities and the value generated. It can be summed up in like very human terms in a very simple analogy. Why do we have brakes on cars? It allows us to drive fast, because knowing we have the brake, we can drive faster, slow down when we need to. The steering wheel lets us navigate. The horn lets us get in touch with other people. The signals on the car communicate what we're doing. It all manages the risk of the situation so we can get more out of it. It's more around the value creation. And in mechanical terms, that means you need to identify the sources of your risk, you need to assess them, you need to manage them, you need to monitor and then start over again, right? Because it's an ongoing cycle. It's not a one-way path. The value is actually in the feedback. And the way we look at those risks is really two dials to turn. What's the likelihood that something's going to happen? Kind of obvious. And then the other one's the impact. So if it does happen, how bad is it going to hurt us? Very simple. And how do we prioritize? Simple. The ones that are going to likely to happen and have a high impact, the ones that were most likely going to happen and hurt us, we deal with first. And then the ones that are all the way on the other end that are low likelihood, low impact, we deal with them last. And how do we deal with them? It's actually kind of simple. Our idea is to take the inherent risk that exists. We apply these things called controls to reduce the level of risk to an acceptable level. It's that simple. And the way we deal with that is we determine is, we get hit with a risk, it gets presented to us. We say, okay, can I accept this? Can I avoid it? Right? If you're worried about tropical storms and you're living in Florida, you can move to the Midwest. You don't have to deal with tropical storms. And usually when you're avoiding risk, you're actually trading one thing for another. So instead of hitting tropical storms, you got to worry about tornadoes, right? And then when you deal with mitigation, applying controls, you're really applying controls like a brake on a car or a seatbelt to reduce the risk. And then lastly, you can transfer it. And most common form is insurance. So that is like ERM in 2 minutes or less. Anybody have
anything they want to add to that?
No, I thought that was great. I mean, when I work with clients, pretty much the simple thing I say is just, what can go wrong? How bad is it going to be? And then what are we going to do about it? And I think Alex captured all of that pretty distinctly.
And Sue's right. That in common human everyday terms, that's what it comes down to. It's that simple.
Yep. And then exactly what Alex said is, are you going to avoid it? Is it something that within your business strategy you can avoid? Is it something that you can mitigate and put some controls around it? Or is it something that you need to transfer, which is what we talk about? And there's different ways to transfer it. I think insurance being the most important or the most common one that's used.
I want to just add one thing, which is the trade-offs to me are one of the most important part of the risk management process. And so when you are attempting to mitigate a risk or you're transferring it, that adds a new cost. So you're getting rid of perhaps that large cost, but you're spending money in some other category. And so what you need to consider is what the holistic cost of risk looks like for your organization. And there are different ways of calculating that cost of risk, but I mean, you could look at it in terms of the retention, the money you're spending on losses, your insurance premium, the money you're spending on mitigation. And what you're trying to do is bring this down to the lowest possible level for your business.
Yeah, that's a great way to think about it. And just in like a real world sense, I have a lot of instances where we have older buildings, like my clients own a lot of buildings, so older buildings where there's no sprinkler system. And the carrier always wants a sprinkler system, so they'll come in and ask for a sprinkler system. And I always have that client that's penciling out the numbers of how much it's going to cost to retrofit the building, maybe even get into some drywall and build a sprinkler system. And then they put that against what the insurance costs for someone who's insuring it without a sprinkler system. And yeah, exactly right, David. They run those numbers and they're making business decisions based on it.
Yeah. And it's also, the costs aren't just dollars. It can be something as simple as friction. Because whatever form of control you use or what form of treatment you choose, there is a trade-off, right? It could be you're not as efficient operationally, you're less effective, you move
Yeah.
slower. You got a maintenance cost. You put brakes on a car, they have to be maintained, right? So there is always some form of cost, whether it's in terms of dollars or not.
Yeah, that's a good point.
Yeah, you make a good point there. And one of the frictions that happens in my world all the time would be litigation. And the things, um, there are all sorts of intangibles that can be pegged to litigation, slowing you down, efficiency, um, you know, just the general heartburn of it, dealing with that. So it's not just the attorney's fees and potentially the judgment. I mean, there's a ton of things that could slow down a business that's in litigation. I've seen it firsthand.
The
Oh,
reputation act, right?
you're
What's
a
that?
brave man, Reed. I think our whole audience is lawyers.
Well, I guess a lawyer talking to lawyers has credibility, right?
That's true. I guess so.
True.
Right. And by the way, lawyers are the only group that exists today that you can pick on in public and they enjoy it.
That's right. It's like a pat on the back. That's exactly right.
It is. And the best lawyer jokes are other lawyers. It's perfect.
Right. Mm-hmm.
Okay, let's move forward. I was taught by Dr. E.J. Leverett, who was described as the Pied Piper of risk management. He built the University of Georgia Risk Management and Insurance Program, which is like ranked number 1 or number 2 in the country the last time I looked. EJ always said that there were certain things you needed to look after, and he summarized it as you got to take care of your people, you got to protect your tangible property, and you've got to protect your profits. So it was people, property, profits. That's not to say there aren't other things, but that was kind of his focus. Was it usually falls into one of those 3 categories. So do you guys see any other major focus areas in terms of risk management?
Brenda, I like that one a lot. The people, property, and profits, and it's all P's, so you can remember it pretty simply. But you're right, and I think even the ranking of those, I think, I like having the people first.
Mhm.
I also think about if you want to add more P's to it, and I think we kind of talked about, but having like processes, like thinking about your process. We all got shocked by the supply chain, what happened in the supply chain right after COVID. So, you have a process in place. What could impact that process that could slow you down, as we mentioned before, cause friction in your operations. I also think with the way the world works right now and how linked everybody is and how much social media is, you have something catastrophic happen, and that can also lead to your reputation. So that's not a P, which I apologize for, but I mean, you're dealing with having maybe clients, customers not come back because they heard about something that happened to your employees or the people that come on site or your building. So I think, people, property, profits, processes, reputation, I think all of those are stuff that have become major shifting for risk management.
I think what we're looking for in a 5th P is perception.
Oh, look,
I like
look at
that.
that.
I like that.
Let's copyright that now.
Yeah, I'm going to have to jump in real quick because I wrote 3 things down and Sue hit 2 of them. So before somebody takes my 3rd, I want it. Trust.
Oh, yeah.
Trust, right? So most of the work I do is in the digital world. Now, most of the world has gone digital, but that means intangible, which means things are about perceptions, process, um, software, data, people, right? It's all about the intangibles. 150 years ago, when famous works were made about what a business is all about. It's all about machinery, right? What physical property do you own? The world has gone digital, which means intangible. Digital trust is a huge factor these days. And there's a lot of studies that show that when reputational damage occurs and there's a loss of digital trust, people are hurt. They actually have emotional reactions because they put their trust in an organization or a service. There's also a lot of evidence that shows that price, speed of delivery, and trust are at equal weights in a consumer's decision. So the trust factor is very, very important.
Very funny that you mentioned those last three things, because I thought of two things, and I thought it in a different way than EJ Leverett would have put it. I thought about this in terms of process, and that is that the first step in risk management is to identify risk.
Yep.
And if a failure to identify a risk is going to lead to a loss that is by definition not covered anywhere else. I mean, you could get lucky, but it's going to lead to an uncovered loss. And so you're paying for that out of your current period cash flows, you're selling off assets, or you're taking on debt to pay for it. So in terms of process, a robust risk identification on the front end of your risk management process is very important. In terms of exposure, though, what I thought about is in terms of what's leading to the most notable bankruptcies of the last 20 years is probably a failure in strategy. And when I teach strategy in corporate risk management, this is not my core area, but I've tried to narrow it down to what do I think people value the most, and it is superior product, better price point, greater convenience. And I think, Alex, the three things you mentioned are basically one of those three things, or those are the three things that line up pretty well. So what is it that your business offers customers? Why do customers choose your business? And what could destroy the strategic niche that you've carved out for yourself?
Anybody have anything else to add?
I think we can stay on this slide for the full hour, but we better not.
Reed, I'm going to pick on you now. What is the biggest loss exposure that you think businesses face today?
It would have to be in a digital age, some sort of breach, some sort of data breach. I can speak for a law firm in particular as limiting my own risk in addition to trying to limit clients' risk. But I mean, the amount of things that we house in a law firm electronically now could be just drastic if breached. And the security measures that we take here eat up a lot of our budget. And it's just a fact of life for any sort of data-driven entity or business today. And so, I mean, there are a number of different ways to do that and to reduce your exposure with things that are far beyond my pay grade as far as what is actually done, but you know, remote servers and third parties and all sorts of cyber risk management tactics that you can take. I think that is the number one exposure today. Like Alex was talking about, we are not a machine driven economy anymore. We are a data economy. And
Right.
the downside of that could just be just terrible for especially individuals. I mean, you're talking about breaches of tax ID numbers, account numbers, all of these things that a lot of different entities will house now as a part of their data.
Right. And, you know, I heard an expert speak on cyber liability and digital exposures a couple of years ago, and I agree with his take on it, which was this can be more catastrophic than any hurricane you've ever seen. Because the average cost of a compromised, say, medical file or digital file, the last IBM study I looked at, and it's a couple of years old, was $168 per record. So you take somebody like Citibank or State Farm, I'm not trying to pick on them, but I'm just saying they have millions and millions of clients. And you start multiplying that by $168 per record if they have a total data breach, and that's a mess. That's a real exposure.
Yeah, it's interesting because if you think, I mean, I look at this through the eyes of a insurance broker. And so I'm delivering to my clients different costs associated with the insurance that they have to do.
Mhm.
And I will say, I do agree with you guys that there's huge exposure, especially with having to run records for any kind of like personally identifiable information that's been breached. And like 4 years ago, we went through a crisis with cyber insurance, like trying to like, you know, just I was delivering like 300% increases. It's been really interesting because in the last couple of years, we're starting to see those prices come down. And what's happening is, I think, and again, this is just I'm on the ground view of this, that our IT departments are becoming so much more sophisticated with looking at the ports. You know, they're getting those data runs from their whoever, their IT consultant or their insurance broker, showing like there's open ports or do they have multi-factor authentication. So we've actually started seeing the cyber insurance coverage come down a little bit these last couple of years because there is some sophistication happening. Now, that's not to say, I mean, these hackers are, you know, they'll keep morphing into something else. I mean, we just had an instance where instead of stealing data or stealing money, which we've seen a lot of money, they were stealing like stocks. So like products that a company was making, they were able to manipulate. So it'll keep morphing. I think my biggest, from what I see for businesses, and keep in mind, I work mostly with real estate companies, is just weather events. I mean, they become more and more frequent. I mean, Alex talked about moving away from hurricanes, but if you guys listen to the daily podcast, I mean, they talked about Iowa having challenges finding homeowners insurance. So I just think they're becoming more frequent. We're seeing costs rise, companies trying to absorb those. And then I think the second thing I see, because again, I just look at where are my clients paying their most premium, is liability. And now Reed, you're gonna have to protect me because I'm gonna start going after the plaintiff attorneys. But like, you know, I was just in Florida last week driving down the road in Tampa, and every billboard was for a plaintiff attorney. And I mean, in Florida alone, I think there was a statistic done by the Insurance Information Institute that talked about that, you know, 9% of Florida claims, Florida files 9% of the claims, but 79% of the lawsuits come out of Florida. So it's just, I think there's a lot going on with liability insurance that's making it very challenging.
Yeah, this is a really good discussion. And I did want to touch on something that Sue mentioned. If you look at the economic reports, right, the risk reports, like out of the World Economic Forum, NACD just did one. There's a few out of there. The top risks are circling around the same three items. Weather, right, which is kind of interesting. Weather, kinetic events like geopolitical uncertainty, and then misinformation, disinformation, which even though they say it that way, they're really talking about digital. So it's very interesting that we have this strange mix of these things we're talking about shifts in the you know, in weather, the uncertainty around the world and all this, and they're manifesting in very, very different ways. It's an interesting dynamic that I find curious, which also means it's harder to manage from a business perspective. Back to the question itself, I usually answer this question and kind of bifurcate it, you know, startups, smaller businesses, and well-established ones. Having worked with a lot of smaller businesses, they know their craft. They really do know their craft, but they don't necessarily know how to run a business. And that uncertainty, whether they're blind to it a lot of times, right? So they struggle with that, and they often get hit with something out of left field that will destroy the business, like a cyber attack. The statistic is something around 70% of small businesses that get hit with a digital incident or a cyber attack go out of business in 18 months. And they never really thought about it until they're going out of business, which is a sad thing to say. The other thing is they don't have the latitude of making mistakes. They don't have the huge cash reserves. They don't have the long-term sticky clients. They don't have the resilience to sustain incidents, whether it be a weather event, geopolitical uncertainty, what have you, right? So it's a different world for the smaller businesses. And interestingly enough, the US federal government actually determines a smaller medium-sized business can be up to $1 billion with 1,500. It's really much larger than we ever thought. Then on the other side, you have the well-established organizations. The biggest risk for me is not necessarily cyber, even though I do, that's been around in that field for way too long. It's the third party risk management and the supply chain. The reason is we are so interconnected. Somebody gets a cold on the other side of the world, we sneeze and don't even understand why. During the pandemic, when northern Italy shut down, every pharmaceutical on the planet found out that they were sourcing raw materials from northern Italy and never knew it. Right? We still haven't fully recovered the supply chain from the pandemic that started in March of 2020, officially started in March of 2020. So third-party risk management and supply chain is where I see the largest loss exposure. But
Okay. All right, let's move on. I'm going to use the dirty I word, insurance. If you're listening to this and you own a business, insurance is what we've always described as a necessary evil of business. But if you've ever had a claim and the insurance company came in and saved your bacon by writing a check, most people appreciate the value of it. Unfortunately, the industry doesn't do the best job of marketing itself to typical consumers. So I want to ask David if you would opine on why insurance is related to and so important to risk management.
Absolutely. Well, I think it runs in circles because when I say risk management, one of the risk management techniques that we talk about is insurance. But insurance, and I'll talk about this in a moment, comes back into risk management as well.
Mm-hmm.
So insurance to me is perhaps the most structured form of risk management that we engage in. So a short definition of risk is uncertainty. Risk is we face uncertainty in loss of property, uncertainty in terms of whether or not we're going to be sued, suffer a cyber attack, suffer a supply chain shutdown that's going to lead to an increase in cost or an inability to sell our product. And not every risk exposure is insurable, but when we have that insurance, we are trading off that uncertainty. So we're getting rid of our uncertainty in exchange for a known premium, generally known. So that's how it's risk management. We are taking the risk, the uncertainty, we transfer it away, and we've managed that part of our books. I'll say again that not every type of risk is insurable. Especially new and emerging risks, there might not be insurance coverage for. Strategic risks, in many cases, there is no insurance for. I actually did a major research project on a reputational risk management product, but I would say there's no real reputational insurance out there. So there are risks that we can't insure. But in the same vein, inadequate insurance coverage for your properties, for your business income exposure, if you are a small business, and for your potential liabilities, inadequate coverage can lead to bankruptcy in the event of a large loss. So insurance is very important as a risk management process. It's one of the risk treatment techniques that businesses and individuals use to manage risk. But I would say insurance also should lead, if properly structured, to better risk management in other ways. So in better risk control. When insurance companies use risk-sensitive premiums, meaning the greater your risk to the pool, the greater premium you pay, insurance companies encourage you to engage in loss control to lower your own risk profile. So through risk-sensitive premiums, insurance companies should help encourage loss control, which is better risk management. And Something that an agent or a broker like Sue can actually help with is also understanding how the deductible that you select can lead to more optimal insurance coverage as well. So not all deductibles are the same. And you know this if you've ever shopped for car insurance, there's a big difference in price if you're looking at a deductible at $250 or $500 or $1,000. And depending on the size of your business, you might consider deductibles that are far in excess of that. And in general, the higher the deductible or retention you are able to select, the more of those smaller, more frequent risks you can keep in-house. And there are structured ways you can pay for those losses yourself. And then the big picture risks are the ones that you transfer off to the insurance company. And that is typically a more cost-effective way to do it. So insurance can encourage different types of risk management. It can encourage more informed retention, which is your deductible, and it can encourage loss control through risk-sensitive prices. And that's sort of my take on that.
That was a fantastic description. That really was.
I get paid to do this. So
Oh. I guess we have to run a bake sale or something, to take care of your time here. But I think there's two things I want to highlight in that. The number one is insurance doesn't prevent anything. Remember, we talked about likelihood and impact? Insurance is really about treating the impact side, right? It doesn't prevent you or reduce the likelihood of you getting in a car accident. It might indirectly, but what it does is if an accident occurs, it reduces your financial burden. Now, to the point that David was talking about, the sheer effect of having the insurance and being conscious of it, and the insurance provider putting requirements on you really does have an effect, but that's kind of an indirect effect. As a matter of fact, there are some interesting studies that show having insurance can make you a target. For example, there was increases in ransomware after companies got ransomware insurance because the threat actors were finding out who had the ransomware insurance and what their deductibles were and what their premiums were, and guess how much they were asking for, what the insurance company would pay off. To what Sue was talking about a minute ago with all the litigator boards, right? If you've ever dealt with a plaintiff's attorney, one of the first questions are they insured? Because they want to know they're going to get paid, right? So it actually in some way can make you more of a target. And it's something that when I work with my clients around risk management, it's a conversation we have to have, and it usually ends with don't advertise it, right?
Gosh, Alex, maybe we are recording this, right? Because I'll have to play this for some clients. And were you going to continue thought, but I just want to support what you just said.
Oh, thank you. The only other thing I did want to throw in is I also wanted to throw something back at what you mentioned. I've consulted with a number of companies actually insurance companies on their cyber policies. And one of the things they're doing is it ties directly back to what David was saying. They're putting all these requirements on somebody to maintain the insurance. You have to have MFA, you have to do backups, you have to do this, you have to do that. In the time of an incident, you have to call us so we can help you manage the incident. You have to use our approved third parties. So it's actually raising the level of cyber hygiene across sectors. Maybe not as fast as we would like or as well as we would like, but it's definitely have a positive impact. I'm really glad you went there, Sue.
Yeah, and I'll tell you, I mean, just again, I'm the person who's in the trench sitting there with the client. When they get those cyber applications, it is like a whole nother language. I mean, they all have to bring their IT department or their head of IT to come in. But if you're sitting there listening to them talk, like maybe you guys would probably understand it. I sit there just in awe because you're right, it's so sophisticated. But I want to go back to it. Oh, go ahead, Alex.
I was going to say one thing about that. What's interesting when an incident occurs and the company files for a claim, one of the first things the insurance company does is they produce your application, and then they go and verify that you were actually doing what you said you were going to do.
Yes,
that
is true.
It's an interesting thing to watch. So go for it, Sue. Thank you.
What I was going to say, Alex, is just tagging on to the back of what you're saying with it is great that you're advising your clients on, be thoughtful about the limits you're putting out there. Because I would say when I started in insurance, like when I started in brokerage, we would get demand letters from plaintiff attorneys that were like, okay, here's the medical expenses. We're making a demand for medical expenses. Every single letter I see, and I know I'm speaking to an audience of attorneys, is just policy limits, policy limits. And my clients work a lot with institutional lenders or banks, or even government-sponsored entities that are saying, okay, they used to say, we want you to carry $25 million of limit on this location. And, over just erosion of that, nuclear verdicts, I mean, those numbers just keep coming down, and it's a completely different game when it comes to how much limit you're taking. Now, you always want to protect the business. So it becomes a very well, not a complicated, but a very involved discussion with the clients about, what are they comfortable with? How are they structured as far as like the different isolation of their entities and their assets? So yeah, that's a really good way, and a good conversation that needs to be had. It's not just, I think there used to be a school of insurance brokerage, which was, well, how much limit can you afford? Like, just get as much limit as you can possibly buy. And I think it's become much more sophisticated than that. And then just a tag on to David's comments about emerging risks, I remember I was an insurance underwriter for a very large carrier, like 20 some years ago. And they came to me and they're like, hey, do you want to underwrite cyber insurance? And I'm like, cyber insurance? What's that? And I remember I could not get anybody to buy cyber insurance. It was like, we'd ask every client, do you want to buy this cyber insurance? And they would not buy it. So it takes a while sometimes for the risk to emerge and for carriers to feel comfortable insuring them. But yes, you're right. The emerging risks are sometimes a challenge.
Okay, great. I'm going to skip that. I'm going to combine these two. And I'm not trying to be exclusive to insurance agents. There are other ways to buy insurance, and the main one is through an insurance broker. We're not going to go into all the technicalities of those, but fundamentally, what should a business owner look for in whomever they buy insurance from, whether it's an agent or a broker? What should you be looking for when you're selecting this person? I've had good agents, I've had terrible agents. What should you look for? Reed, you want to take this one?
Yeah, sure. I mean, just speaking in generalities, there's no substitute for experience. So somebody who's seasoned and knows what they're doing. Also, there are some instances where you may be looking at multiple products and the ability to shop and have experience levels in multiple areas in one house may be a good thing for certain businesses when they're searching for experience. So maybe just depending on what you're looking for, of agency or a firm of a certain size with multiple departments could be helpful for a lot of businesses who are searching for someone to sell them insurance. But like I said, I really don't think there's any substitute for experience and someone who will advocate on your behalf too. That's
I would say the things that I've seen over my career, one of those things is absolutely integrity. Insurance is a promise to pay. If the person selling you that promise is willing to lie, cheat, or steal to get your business, you got a problem. The most common thing I see with at my place of business and where I work is people find that, and this is a micro example, but they find that sometimes the insurance agent encourages them to lie on the application for auto insurance. Who's really driving that sports car? Is it you, Mr. 50-year-old excellent driver, or is it your 16-year-old new driver? And I actually have my students do a project on that every semester where they have to go explore their own insurance to see if there's anything weird like that going on. So I would assert that you've got to find somebody who has integrity, who will do the right thing because it's the right thing to do, and not just to generate a commission. I think that's very important.
Yeah, and I could probably talk on this till the call ends, but I'll try and keep this brief. But I think it has become more sophisticated for different segments of business. And so I think you want to look for someone who maybe, or someone who has a niche focus. There's certain, you want somebody, and I'll just go back to, like, I work in real estate. You want somebody who knows what a typical lender agreement looks like and what they should be asking for in that insurance coverage. Because a lot of my conversations with my clients are, well, what they're asking for is not standard and accepted. And I don't want to keep haranguing the lawyers on the call, but the lawyers sometimes will just put stuff in there that can't be insured through an insurance policy. So you want to be working with someone who can give you that advice that this is not standard. You should be able to push back on your bank about this. I also think you want to be with someone who can communicate well, which means speaking plainly. So I've been in meetings where people are speaking in all acronyms, and when that's an IT application being completed for cyber, that's fine. But when you're a business owner, when you're a CFO or general counsel trying to figure out whether you were going to put the company's assets at risk or what decision you're going to make, you need someone who's going to explain it to you in a way that you can understand. And one of the smartest CFOs I've ever worked with, I watched someone give a presentation to him and spoke all in insurance jargon. This was not me, but spoke all insurance. And he basically, at the end of the conversation, said, I cannot buy from you because I do not understand what you're saying. So I think that's really important. I also think access to a wide breadth of carriers. I think having a claims team, and then I just think having good service. It's sadly, a lot of times nowadays, everyone thinks everything can be done online, and commercial insurance, at least, I think is something that does require somebody sometimes to pick up the phone and have a conversation with you about stuff. So again, I will stop talking.
And I'll just underline points that were already in what's been said for emphasis. When you're talking about business insurance, which is really what we're talking about here, you need somebody who understands your business and the sector you rely in, and also the size, right? So if you're a large multinational publicly traded company looking for directors and officers insurance, that's a very different policy than if you're a small business looking to insure a fleet of vans, right? You got a very different thing going on there. Also, like very common insurance is like business interruption insurance or key person insurance or disability. Those are very different lines, and you need a carrier that can actually create a mosaic of your policies where they work together but don't necessarily overlap, right? It know some work with people that understand your business, your size, your the type of product you're looking for. Somebody who's got the experience dealing with folks that look like you.
I agree.
I have only one thing to add, which is I was at an independent insurance agents event in the fall with a group of students. And it's interesting for them to kind of hear about this business. But one of the people speaking there was talking about how do you go acquire new business? And they were talking about real strategies. And they kept using the term pain points. And this is for anybody, here that is a business owner. If you've had to deal with your insurance agent before and they're not getting back to you and they're not getting the COIs to you, or they're not doing whatever it is you need, those are pain points. And a good agent understands what those are and is probably going to be very responsive and is going to get things to you quickly.
Great.
Yeah, you're right on that, David. It's funny how those little pieces of paper can slow down multi-million-dollar transactions. I always tell my team, I'm like, we never want to be the reason where a closing is not happening. Like, huge.
Yeah, and what David said in there is important because there's certain clients that want the evidence that you have insurance. They want to be the co-insured. And if you're not turning around that piece of paper quick enough, you're hurting my business. You're reducing you're making my life harder to pay my employees, right? I got commitments. And if you can't get me a simple piece of paper that's core to your business, why should I think you'll be there when I really, really need you?
Friction. It's more unnecessary friction, just what you said in the beginning. Friction. Yeah.
Yeah. Okay, Reed, I want to turn to you again. We talked about this before. Who should be on, we all have friends. We all have advisors and we all have mentors. But if you're a business owner, you need to assemble a team of advisors and consultants and uh, mentors to some extent. Who do you think should be on that team?
Well, certainly a CPA. I mean, just depending on the business, you're going to have all sorts of returns and reports, and a multitude of things that you have to do tax wise. And I come at this more of a small business lens and assuming these are folks out of house that you're working with. So certainly a CPA who knows the ins and outs of your business and someone you can pick up the phone and have a good relationship with is just invaluable. That's when I set up new entities for folks, I may not even set up their entity until they've sat down with a CPA and have made an informed tax decision about what sort of entity formation requirements they've got that they need met. So certainly an accountant, certainly an insurance agent that can explain to you what you need by statute or just by operation of law, what exactly you need and what exactly could be a benefit to you that you don't necessarily require. Also, from a formation and small business side of things, certainly an attorney. And like Sue was saying, an attorney who specializes in small to medium-sized businesses, not the guy, I don't want to, throw mud here, but not the guy who does drinking tickets and bankruptcies. I mean, that's not the guy you want. If you are going to be serious and actually have some legitimate legal needs, and I think any sort of, whether it be transactional, the purchase of a business, the sale of a business, the formation of a business, um, you need somebody who specializes in that. And it's really more than filling out forms with the Secretary of State. You need to understand why you're doing certain things, why you're selecting this entity, and you need good, strong formational or transactional documents that evidence what exactly you've done for tax purposes, for purposes of preserving your corporate veil, all sorts of issues that could come up. In addition to that, I would say some sort of third party or outsourced IT if you're small, somebody to ensure that you have adequate data protections. That may be through insurance or that may be through processes. And if you are a business owner, you likely don't know the ins and outs of what exactly you need and how to protect yourself. And then finally, a banker, and not just opening a bank account. I think it's a tremendously valued to have someone you can call and that knows your business and specializes in your sort of business and can assist you, whether it be with lending or other needs along the way. So that would be my answer.
Great. Any other thoughts on that?
I think one of the things we have to keep in mind is a lot of this, again, depends on the size. It depends on what your business model is, what your sector is. Depending on the size of the company, privately held, publicly traded, the way it's incorporated, there are legal requirements about who you can and cannot have on your board or your advisory board. So that's an excellent conversation to have with your corporate attorney. And to Reed's point, you want somebody who's been down this road before with somebody else, right? You don't want to be the test case. Now, there always has to be a first time. You just don't want it to be you. And the funny thing is when Reed talked about, DWIs and stuff, part of me wanted to snicker because I always say you have to choose your advisors based on the nature of your business. And it made me think that if you have a management team that needs a DWI attorney on the advisory board, you probably have a different set of problems, right? So it really, you really have to keep all this in mind. It's got to be appropriate for your size. You want people that will be experienced. There's legal requirements of who can and cannot be on your board. And there's one other thing. Quite often, if you have a capital intensive investment, a business, where you need lines of credit, or you have investors, they are going to demand board seats, voting board seats. They're also going to demand visibility into the advisory board because they're protecting their investment. You have to account for that, but you also need to augment that with people that are in looking out for your best interest, not their financial interest. And I see that mistake a lot where a business owner will confuse the true loyalty of these advisors. Be mindful of it.
Thank you. Last question. We're approaching the end of our time together. What are the major risk management mistakes that you see businesses making? I'll give my example, and that is what I call the Titanic effect. Everybody on the Titanic, including the engineer that designed it and the captain who steered it, everybody thought this was the perfect ship. And it wasn't. And, the people that built the World Trade Center towers, those were supposed to be earthquake proof, and they were, but they weren't airplane proof. So my answer to this is, underestimating the maximum possible loss. I think a lot of places don't do that. And to go back to cyber, I think that is a huge exposure that a lot of big companies are acknowledging and a lot of small businesses are acknowledging, but I think a lot of them are underestimating the maximum severity in terms of loss. Alex, what do you think?
I think there's because you said, what are the major risk management mistakes? It's plural, right? Because it's not like there's one that stands out, but there's definitely a group. And what you mentioned there, Brenda, is very, very important. Probably the number one mistake is complacency. With the way the technology is evolving and the way business models evolve, we are seeing disruption at a massive rate, massive rate. So you can have somebody come out of left field on you and totally disable your business. Look at what happened this week on DeepSeek, right? It's totally upending the market for NVIDIA and OpenAI and a few others. There's famous examples where Kodak was put out of business because the world went digital, but they had the digital patents and sold them off because they didn't want to disrupt their supply chain, right? Xerox is no longer around, but they're the ones who created the graphical user interface we all use, color screens, Microsoft, the mouse, all these things, but it just wasn't core to them making Xerox copies anymore. But disruption is happening faster than ever. So I think maybe who wrote it? It was a former CEO of Intel, which is kind of ironic, said only the paranoid survive. So I think getting too complacent, having too many advisors that are friends, being surrounded by yes people, I think those at the end of the day are very common mistakes. And Brenda, to your point, underestimating the significance or the true impact, the aggregate impact of what you could be dealing with is an incredibly easy thing to do.
Yeah, and I'll
Anybody
just jump
else
on.
want to Oh, sorry,
Yeah, I'll
Sue,
just
go
jump on real
ahead.
quick. I think one of the greatest things about my job is I get to see a lot of different companies and how they operate and how the different C-suites. I always tell my team it's like we're getting an MBA every day. And one of the things I notice is like the companies that are really, I think, cutting edge and leading the way and growing is the ones that have broken down a lot of the silos. You'll see sometimes where it's like, well, this is our department, this is what we do. But in risk management, this is probably what David has to, with enterprise risk management, is break that down and have all these different operations talking to each other, because all that is grist for the mill to make the best decisions. So I think breaking down the silos and really making it something that's across the company, I think is critical.
I would say a failure to engage in the risk identification process fully, ending risk identification before you've identified all material risks, or failing to revisit the risks that you have identified 2, 3, 4 times per year to make sure that you really have gotten your material risks. That's a critical mistake. What Alex said, I want to say again, more or less, because that's when I teach corporate risk management. The very first lecture I give is on strategy, and Kodak is one of the examples I give. But a failure to understand the strategy of your own business and why customer trends are changing is going to lead to bankruptcy, because the saying, people love to use that saying, the customer is always right, and they think it has something to do with customer service, but it's not. It's that you can't ignore consumer demand. As technology changes, consumer preferences are going to change because products are offered at a better price point. They're more superior, or they are superior to prior products, or they're much more convenient, and people will pay a premium for convenient and superior products. So understanding the strategy of your business and what it actually is you offer to the customer, I think, is very important. A failure to do that is a failure in strategic risk management.
I certainly come at this question from the lens of my practice. And one of the things that I've seen cripple certain small businesses in very unfortunate situations is lack of proper estate planning, whether it be lifetime documents, a power of attorney, or some other shifting of authority during lifetime or after lifetime easily will just cripple somebody or an entity that relies on its principle. And sometimes that can be avoided by certain, very simple estate planning tactics. And so that would be one of the ones I've seen personally in my practice. And just a lack of having a good advisory team around you, I think, could really, really hurt the small business owner.
Okay. I want to thank you all. I think we're out of time. Are there any brief final thoughts you want to share?
No, thanks for the opportunity to talk today and to meet these fine people and be on a panel with these fine people.
Yeah, great.
Thank you, Sue.
It's a lot of fun. I would tell the audience that, you have our bios, connect on LinkedIn if you have some follow-up questions. I think any of the panel members would be open to that. And, Financial Poise does a lot of sessions like this. Keep abreast of what's going on. I've been doing them for a couple of years now, and I always learn something.
Excellent.
Okay.
Thank you.
Well, thank you all for being here. And if there are any questions or anything, again, as Alex said, please feel free to reach out to us or email Financial Poise. Thank you. It was fun.
Bye.